We have a question from Abu asking, what is the RRR from the PBOC and why is it significant that they slash the rate? So thanks for the question, Abu. So the RRR is the reserve requirement ratio for the PBOC. And it was put in place by the bank in 2015 when they really struggled to contain a very rapid devaluation of the Chinese yuan. Now, the rate before today's cut was 20%. So that essentially meant that financial institutions were required to hold 20% of foreign exchange sales at an interest rate of 0 for an entire year as a type of risk reserve to stem the outflow of the Chinese yuan. So basically making it more difficult for investors to bet against the currency, if that makes sense. So by cutting the RRR, or the reserve requirement ratio, for financial institutions down to 0% today means that financial institutions will have increased capacity to expand their lending to willing borrowers, which means that the bank is basically relaxing capital controls, and that increases the available liquidity in the system by freeing up more money for people to borrow from these financial institutions. And at the same time, it also increases the market's ability, as we said, to bet against the Chinese yuan, as that risk reserve is no longer required. So these types of cuts usually occur when the PBOC is comfortable with the strength of the yuan, but don't necessarily want to set a weaker daily fix for the US dollar Chinese yuan midpoint, if that makes sense. So by choosing to allow markets to increase that two-way flow of the currency is usually a sign that they are more confident in the fundamental outlook for the currency. And also, not only in those environments, but also in environments where they just want to stimulate more borrowing by cutting the reserve requirement. So is this a negative for the yuan if it means increased lending capacity? Obviously, that should be good for growth. So why is it bad for the currency? Well, in the short term, it all just comes down to liquidity. So by removing that risk reserve, it gives the economy a liquidity injection, which is negative for the currency from a money supply point of view, of course, and it also increases the likelihood of outflows in the currency as well. Now, it's usually seen as a positive for risk assets, as more liquidity and more lending capacity should be more positive for growth. And the implication of this also stretches to the Australian dollar, which is usually seen as a proxy for Chinese sentiment. Which means that the Aussie dollar and the Chinese yuan usually has a strong correlation versus the dollar. So let's quickly go to the Aussie versus the US dollar, and let me just illustrate that for you. So let's just put on the Chinese yuan versus the dollar here for a sec. And you can see that we normally have that strong correlation between the two, because the Aussie dollar is normally seen as that proxy for overall China sentiment. So, if the RRR is cut or hiked and it impacts the Chinese yuan, it can also impact the Aussie dollar and to some extent also the Kiwi dollar. But, before just jumping in and trading the Aussie dollar or the Kiwi dollar on the back of a RRR cut or selling or buying it on the back of a hike, for example, we need to understand the context of the cut. So what does it mean for the overall economic cycle for China that they're currently in? And of course, what other factors might currently be influencing the Chinese yuan as well as the Aussie dollar at that time? So hope that helps with your question, Abu. Any others, as usual, please don't hesitate to let us know.